Good afternoon, everybody. Welcome back to Markets for Millennials for the weekly market wrap from March the 7th through March 11th, and coming at you shortly after the close of the futures markets. New York session has been closed for a little over 2 hours, and just kind of a really interesting week. For this update today, I'm going to kind of just briefly go over some equity market stuff. Not a whole lot has changed in terms of the outlook on the equity markets. We just have a lot of uncertainty, and I just thought it would be appropriate to take a look at a couple of other things that we don't normally do in these weekly videos, just to be aware of some things as we look forward to next week and the weeks to come. So just kind of, again, big picture, we have the ongoing Russia-Ukraine war. Definitely our hearts continue to go out to innocent people who are being affected by this. We have the U.S. response and the response of various countries around the world in the form of sanctions. We have companies pulling their businesses out of or suspending their operations in Russia. We have whispers and rumblings of continued expansion of this conflict or escalation of the conflict. So we have the geopolitical situation that's continuing. We had a CPI print this week in the United States at 7.9%, which obviously the number is probably actually a lot higher than that, but that's the official number that they give. So inflation continues to expand, and again, that is up higher than the last CPI, which was 7.5%. And that was also before most of the CPI is taking into account things that happened where over the course of time where the Russia-Ukraine situation hadn't actually started yet until like the very end of February. So this CPI print for the coming month, for the month of March, is probably going to be significantly higher. So we have the market digesting that. We have an FOMC meeting on Tuesday and Wednesday of next week with the press conference to follow the conclusion of their meetings. There's a lot of things, a lot of potentially market-moving things taking place. And so we have to be aware of that backdrop. We have to be aware of what's happening in the overall economy. What are the markets telling us? What are different things, not just equities, not just gold or silver or yields, but like what are all the different key market indicators telling us? So we'll start with the dollar index just to get our foundation. And this week we had up days, down days, and then up days. And on the week, we finished up a little over 0.5%, which is definitely a lot less than our 2% week that we had last week. What drove this price action? And I have been pretty adamant on Twitter and on this channel and in my newsletter that what we need to be really paying attention to is not so much the dollar, but the euro. Because the dollar index is more than 50% weighted to the euro, and on this 1 hour chart comparing the euro to the US dollar, British pound, Australian dollar, and Japanese yen, what you've been seeing for days now is just this massive sell-off versus basically all of these currencies, with the one exception being really the British pound. The British pound and the euro have kind of been neck and neck, other than a quick sell-off between the 1st of March and the 5th or the 6th of March. And I think that that's really important to notice, especially considering that when you look at risk-on, risk-off currencies, in the currency markets, you continue to see strength in the currency in the risk-on currencies, the Australian dollar and the New Zealand dollar. And if I compared these also to the Canadian dollar, you'd see similar strength, although not quite as pronounced. And as I've gotten to thinking, my view on this has kind of evolved over time because the Australian dollar and New Zealand dollar are also commodity currencies. And so with commodities spiking the way that they are, in many cases, it makes a lot of sense that these currencies are gaining a lot of strength. But what's interesting is normally when you have a risk-off period, you see more strength, especially to the Japanese yen from the Australian dollar and New Zealand dollar, and then a little bit more subtly, but still definitely significant to the Swiss franc, and you're just not seeing that. You're seeing continued strength into the risk-on currencies versus risk-off currencies, and that coupled with the weakening of the euro. And so I think that that's kind of why you're getting dollar spikes with gold and commodity spikes. And then, of course, because obviously in uncertainty, we talked about this previously, you get the moves into gold. Oops. Hold on a second. Sorry. Let me see. This is the euro, US dollar. Got to fix my chart here. I got to go back to this page here. Sorry about that. Where you get your moves into gold, which interestingly also kind of cooled off a little bit into this week. And so on the week, we still finished green, but up less than 1% versus last week's, almost 4.5% move up. And so we've seen that come up. We've seen oil coming up, which also has seen this pullback, and actually on the week is 5% down. So very interesting, but still definitely an uptrend. Still a very strong trade. Just kind of got a little overheated, and so I think like the key is to understanding like we have the rising currencies which are pushing commodity currencies higher even versus risk off pairs. We have that with the demolition of the euro, which is happening, in my opinion, as a result of the uncertainty in Russia and Ukraine. And definitely the British pound is feeling that as well. And then in light of that, people are buying the US dollar as the world reserve currency. And they're also buying bonds, or they were buying bonds. Now this week is really interesting. This week, we basically, on the weekly chart, we completely engulfed our candle from last week where we lost almost 12%, and this week we gained 15%, closing on the week at the highest level on the weekly candles at least, and fairly close on the daily candles to our highest closing price ever, closing today at 1.997%. So just a hair under 2%. And so people have been seeking the safer bet, although in this case, we see them selling bonds. This all week they sold bonds. So that's another thing to think about. So conditions up until this week, I mean, last week we really talked a lot about flight into safety. But this week, the selling of bonds, which is causing yields to rise, the selling of gold, the selling of oil, but yet the dollar, after having sold down a bit, is still ending up on the week. So something has changed a little bit this week, which I think is kind of interesting. We've also got the VIX, and actually let me turn this into a line chart. It's a little bit better that way. The VIX is staying elevated. In fact, today the VIX looks like it's going to close over 30, or looks like it has closed over 30. And it's been a while since we've closed over 30. I mean, we had a couple, starting in late November. But otherwise, you have to go back to, much earlier, January 2021, and then before that, and that was on the way down, still from the COVID crisis. And so what I think is interesting is on the VIX, we're getting these spikes higher where we've got this kind of rolling bottom, which is getting steeper. And I think that is worrisome, all things considered. So risk in the market is increasing, even as people continue again to sell the euro and buy the Australian dollar and New Zealand dollar versus the risk-off currencies. One thing I wanted to put up here is the yield curve, the tens minus the twos. And again, looking at this, the yield curve, I've got this line marking the zero line. And obviously, those of you, if you don't know, many of you do, but if you don't know, when the yield curve inverts or goes negative, the twos and tens yield curve, it always predicts a recession. So you saw that happen back before the great financial crisis. You saw that happen in 2019 as the repo market went crazy, and right before the COVID crash. And so those are always big signs of things to come. And what I think is interesting is just over time, let me go to a 3-day chart. You can kind of see a lot of times these moves are a little bit more gradual. This one is, it looks like it's like what is the inverse of parabolic? I don't really know, but that's what's happening. And so we're watching definitely the yield curve continuing to get sold down. And so that's something to be concerned about. When the yield curve is coming down, then what that means is that people are seeking safety in shorter term bonds versus longer term bonds, and so that's a big deal because typically people typically want to find want the longer term maturation of bonds, and so again, the way that it works is when bond prices go up, yields go down. When people start selling bonds and the bond prices go down, the yields have to go up. And so essentially what that means is that people are definitely buying certain bonds more than other bonds and selling certain bonds more than other bonds. So it's something to watch. And then the other thing that I've been watching is it took me a long time to figure out like just one good place to find or like different kinds of things to look for to find spreads. So I did this a couple of ways. I found this high yield index option adjusted spread, and basically the concept of spreads is when the spread widens. So when this chart starts going upward, what that means is the spread between the yield on different types of bonds is increasing, and when that happens, it typically means they're selling like the higher yield bonds and going more into safe bonds like the 2-year Treasury or the 10-year Treasury or things like that. And so the basic principle of this is when the spread number again goes up, that is a sign that the market is getting spooked. And this is actually like the credit spreads are actually things that the Federal Reserve watches more, I think, than anything else, or it's among the things that the Fed watches more than anything else. So you can actually see the spreads taking place, that trade taking place, the spreads widening a ton during the COVID crash. And if you pull back, anytime we've had these periods of time, so like late 2015, early 2016, we had those spreads come out. And then we had the big move in the great financial crisis where that took place. So as you see those come up, it can be worrisome. What you'd rather see is kind of just this kind of straight along price action like you see during this kind of range if you follow my mouse, where it's a little bit more flat and level at a lower level. That's typically what you want to see. And so I think by looking at this, and also I put it in a different way, I found a couple of indexes that are looking at kind of 10-year maturity, high quality corporate bonds versus the US 10-year. So these are both 10-year maturation. I mean, you can kind of see that same rise taking place. And so I think that is a pretty important thing to watch as credit spreads start to widen. Again, this is the thing that the Fed looks for. So I'm wondering if, in light of the fact that we have this geopolitical situation, we've got the market spooked, the yield curve continues to drop. Are we going to get is the Fed going to spook, and will they, I don't know, like, I'm not trying to say that they're going to pivot away from raising rates at all. I think they will get maybe one or two off the rate increases, which they'll be minuscule and meaningless in the end. But are they going to get spooked away from being more hawkish about like bringing, getting those rates off the ground and like getting more rate hikes in throughout the year? And I just don't know. It's very uncertain. And so with all of this in mind, what's been going on the equity markets? You can see here once again, markets are trending down. We had a really huge bounce, over 100 S&P points on, I think that was Wednesday, and we've given most of it back to close the week after a pretty large wick up Today, still well below. Let me turn on my 50 and 200-day moving averages. Still below that. We're about to get a cross on the S&P, which you can't always. That the cross doesn't mean that it's going to continue to go down, but it is something to kind of watch for. If we don't get some buy-on dips up here, if we don't kind of see price bottom out. So I'm actually watching this wick right here where this green wick is touching and kind of in that general area, or right around this this green horizontal line. I'm watching that as a level to see once we get this cross, because it seems inevitable. I think it's inevitable we're going to get this cross on the moving averages. And so the question is price going to continue to follow through to the downside, and are we in for an even deeper pullback, or is this going to be it? NASDAQ, same story. We've already gotten the cross. I talked about that, and look at that once again. The level that I was watching as important, that's where the 200-day moving average is leveling out and starting to curl down at, and so definitely not looking good there. The Dow, we've got a cross on the Dow, and we are on our way lower on the Dow. And the Russell, what's interesting about the Russell is, and I've talked about this a lot. I mean, how many times do I need to talk about this? When the other indices were on their way up, the Russell was sideways. And now that the other indices are on their way down, the Russell is kind of trapped in a range right here. You can actually see that range is getting squeezed a little bit more. So then the question is this going to break down or is this going to break up? And I think that'll be telling. So I actually think the Russell is going to stay sideways until we get to that breaking point, and then it's going to either move down with equities or it's going to break up and the other equity indices will have finally made a bottom and then be on the way up. So definitely this kind of sideways range. So if you don't want to look at it, I know I just keep erasing and redrawing stuff. If you don't want to look at it as a sideways triangle, like I have it right there, then definitely the levels you want to watch, the upside and downside, are right there, and I have a short line right there, and about right there, kind of this sideways price action right here on the Russell. That's what I'm going to be watching. And then I think I already kind of talked about yields. You can kind of see yields getting, bonds were getting sold, and so that's why the yield is coming up. We talked a little bit about gold pulling back, and silver also pulling back on that. But interestingly, in spite of the pullback, we've got both silver and gold above, pretty interesting and important levels. I think it's a big deal that silver is closing above 25.75. And I also think it's a pretty big deal that gold is going to close above 1967. In my opinion, these are both going to come back up, and gold will make an all-time high. It might take, it could be next week, it could be in a couple of weeks, but that's kind of my view on that. Oil's interesting because if you go to a weekly chart, I think I talked about this previously, and let me turn my moving averages off. But you can kind of see how I have these various supports. That these are all long-term supports to the like kind of in a bullish direction and in a bearish direction, and so I started with that, and it's kind of interesting to see oil closing after having come down and closed a little bit below. We have it closing the week above, kind of a confluence of those levels. And I don't know if it means anything. I don't know if it means that that oil is going to, stay above this level and continue up. But it's something I have to pay attention to. On top of the fact that we have this is kind of our trend line. If oil were to break below this trend line, then we'd be looking at either some prolonged sideways action or some further moves to the downside. And so that's something to watch. Bitcoin continues to be range bound. I drew I put this red horizontal because some people are looking at it as a ascending triangle. I am looking at this more of a wedge. regardless, the levels are, the level to the downside is the same. You want to be kind of watching this trend line to see if we get a breakdown. It's interesting, over the last few months, we've had a couple of really strong days. We had a 11.45% move to the upside. We had the really big 14.5% move at the beginning of last week, and then we had almost 8.5% move on Wednesday this week, and every single time we just keep giving back that level, those gains. What I think is interesting is obviously we're going to continue to trade 24/7 here on Bitcoin, but I had this dotted line, so let me just give you some backstory. Originally it started like this, and then I moved it to like this, and then I moved it to like this, and then once the line from here had the breakout, and you can kind of see down at the beginning of February, when we had the pullback here on the 10th of February, I moved the line here, and we saw it as resistance, and then we broke above, broke back below. It was resistance, broke above. And I think it's interesting that we have some support right here, that we've been proving it as support right here. And I also think it's interesting on my ascending trend line for the bottom of this, of what I'm still calling a wedge, whether you think it's a triangle or a wedge, whatever. On this confluence, are we going to get a good push up? A couple of things in Bitcoin coming up. We have the Bitcoin bond, which will be offered at some point next week, I think. Before the end of next week, it should be offered. And so, supposedly like half of that offering is going to go into buying Bitcoin. So will that be cause for a pretty momentous price rise in the midst of basically record long-term holding that is going on, and illiquid supply at all-time highs, and things like that? I don't really know. It's hard to really know. But in spite of all that's going on, if you really think about it, the way that the equity markets continue to sell off, and Bitcoin, although it's, we've been, kicked down a whole bunch of times, it is very interesting that we are continuing to make these, incremental higher lows. And so I think that is something to take note of. So that's my look at the markets this week. Be very careful. I think the best position to be in right now is on the sidelines. No new trades, unless you believe that you're an expert and you can, and you feel like you can trade range bound, or trade short, which I try to stay away from shorting, because you just never know when the short is going to go against you, and your losses from a short could potentially be infinite. So it's just something that I personally stay clear of. But it's just my view that in market uncertainty, you just protect the positions you're already in, and you don't enter anything new unless you have clarity about where things are going. And it just, to me, doesn't seem like anything is clear. So that's my update for this week. I hope that this was helpful, getting to look at some other things from normal. I hope you guys have a great week. Stay safe this weekend, and I hope you guys have a good weekend, and I'll see you next week.